Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves those markets. This week we'll start, as always, with a brief recap of the week, and we're also going to get into the technical analysis on a more detailed level, as well as the fundamental recap as to what has transpired this week and what we see transpiring in the future weeks that will impact the gold price.
Yeah, Tori, gold down about 5% from our recording last week to 3170, a little under 3,200 an ounce, coming off the significant high, scraping 3,500 here a couple weeks ago. So that puts us down about 7% since the most recent high and 9% since that almost $3,500 all-time high back in April. Sticking within some trading ranges that we're going to take a closer look at here in a few minutes. Silver is actually relatively stable and been sitting around $32 an ounce now, with about a month-long trading range up and down about 3%. And despite not entirely following gold up and down, silver is still looking pretty healthy. We always like to take a look at platinum versus palladium, a couple industrial sister precious metals. Platinum stable in the 960s, not really up or down this past week, just treading water there in the mid 900s, but arguably inching its way up with a little bit of a short-term declining trend, and we're sitting at the top end of that. Palladium, relatively similar, although technically down about 2%. It's also been in a nice long-term trading range and sitting just below platinum this week at $950. Palladium's long-term trading range is now at about 16 months. Of some pretty significant movement up and down between about 1,050 and 850, so we're still parked right in the middle of that. Quick glance at the paper markets. The S&P back up a little bit more this week, about 4%, sitting just under 5,900. We're coming into some important resistance area just below the previous high, so I do think the stock market, after that 20+% decline, really deserves some eyes here over the next couple of weeks to see if we can push back up towards those previous highs. And everything revolves around the U.S. dollar, Tori, and the U.S. dollar, while up about 0.5%, currently sitting at 101.5. That sub 100 number we saw back in April, that breaks a 3-year floor that we talked about on our show a couple weeks ago. And although we have pushed back up in the dollar slightly, I don't know, Tori. I think arguably the dollar continues down. So where do we want to start this week with some deeper look at a couple different market charts?
Well, let's do a deeper dive on the dollar, because I think it'll help lend a little bit of color to the conversation as we dive deeper into the metals. That dollar conversation to me is very, very intriguing. 2 weeks ago, you had a great image on that inverse correlation between the dollar and the gold price, just mirror images of each other. Is there an expected continued rally here? I'll preface it by saying President Trump wants a weaker dollar. And so you make that comment, and that's justifiable. What we may see here is a continuation of a little bit of a pop, and we'll get into some of the fundamental reasons for that later, but let's do a little bit deeper dive on the dollar.
Yeah, well, you want a weaker dollar, but you want a weaker dollar alongside lower interest rates. What you don't want is higher interest rates and a weaker dollar. I don't know if that necessarily helps anybody.
We've got to avoid inflation at the same time. They've got this tightrope that they're walking of trying to improve our exporting and employment environment, if you will, and yet not driving inflation significantly higher.
Right.
And part of the reason I think that gold has come down and the dollar has gone up is going back to last week's failure of a rate cut and next month's expected failure by the Federal Reserve to cut rates, even though, again, yesterday, President Trump came out saying that Chairman Powell is too late to react and that he should be cutting rates already because, again, that's stimulative. But do we want to stimulate inflation? Absolutely not. We'll get into some of that later, too, because the CPI numbers are actually showing the opposite.
That's pretty important news on where core CPI has gone. But before we leave the dollar, I do think it's important to mention David McAlvany, president of our company and host of the McAlvany Weekly Commentary podcast, which we encourage everybody to listen to as well, brought up a good point here recently. Maybe this is just the eye of the hurricane, but April actually, despite all the tariff concerns and price movements and everything which leads into that CPI conversation, April, we had a surplus. If I'm not mistaken, according to Dave and some research he did, I think it was the first Fed surplus for a month since 2001, which Bush inherited from Clinton. So we are looking at least a 1 month Fed surplus. Now, a lot of that is coming on the heels of things like some delayed tax payments coming out of California and the likes that boosted some numbers in April. I don't know yet if this is a new trend to come. I'm sure we would all love to see that, or if this is just maybe a port in the storm, as we're seeing some massive changes take place right now with the additional tariff boost as well as some other one-off indicators. So we'll have to see how this plays out, but ultimately higher interest rates without the Federal Reserve playing ball with Trump and him continuing to push for a weaker dollar policy, which would include lowering interest rates, which certainly is his hope. What concerns me is the fact that we're not seeing lowering interest rates, but we are seeing pretty much all of the benefit gained from those interest rates in the dollar valuation globally practically gone at this point, with the dollar pushing back below 100 here recently and probably continuing down.
Yeah, even though in the short term, this trend may continue, once we've headed north of that 100 mark, again, you kind of drew a really beautiful floor in an image a few weeks ago on the US dollar index chart. And that long-term support, once was broken through, became a point of resistance. And it didn't take too long to break north of the 100 mark. So now it wouldn't surprise me a bit to see the dollar even go flirt with 102, 103. Just in the short term, it goes against the intermediate and long-term objectives of this administration. So the long-term picture, again, is for a weaker dollar, and weaker dollar equals higher gold prices in the long run. But be prepared for a little bit of a pop. So let's dive a little bit more deeply now into gold. And what do you see as support levels to the downside? Because we're in a correction or a pullback here, if you will, what are some target figures for you, Miles?
We're coming off a pretty significant run in the physical precious metals, namely gold. I don't even know if I should say physical metals because silver did fine, platinum and palladium did nothing, and gold has been gangbusters. For the last month or so, Tori, one of the big topics that we've been trying to remind our listeners of and trying to encourage people to look at it through this lens, this has been a top-down market push into gold. So you're looking at a relatively gradual downtrend over the course of April in gold. If you're looking at the price of gold here, you're seeing us putting in a top at around 3,500, and then some stair steps downwards that have been relatively gradual. I've always argued that reversals happen quickly, continuations take extended breaks. This is a vacation from a, 13, 14-month push. How long has gold pretty much been going up nonstop now? Over a year.
It's beautiful, other than the post-election little breather that it took to close
November
2024.
Thing. Coming down off of the 3,500 high, we've stair-stepped down to it, but it is actually significant that we're now looking at sub 3,200. So gold's off about $300. If you look at just the last push in the gold price, which started back in January around 2,650, 2,700, and stepped all the way up to 3,500. We're sitting at our first major correction on the short term, just this final last push up in gold. Our first major correction, the 618 Fibonacci correction, sitting right at or just below 3,200. And then coupled with that, if we look at a longer term chart of this entire move, we're finally seeing our first longer term Fibonacci correction, the 318, which is exactly what it sounds like. 618, that's about 61% retracement. 3 steps forward, 2 steps back. The 382, that's about a third. So we've taken 3 steps forward in the long term, and we have finally taken a real step back. Tori, believe it or not, for the first time in over a year, we've had an actual correction. I cannot believe it. And from my perspective, one of the biggest things about actual corrections is they convince us that the market is still relatively healthy. So this is not the big breakout move, that big manic, crazy, say, post-2008 market crash rise in gold quite yet. We still don't have that third phase, that final phase push in gold taking place yet. This is just normal trading. An analyst, Tori, that I know you and I both like to read, Chris Vermeulen over at the Technical Traders, put out a great video a couple weeks ago comparing the current gold market to the 2008 market crash that I know you've seen because you shared it with me.
Oh, it's just wonderful. And it really goes objectively pointing to what we all sense subjectively. Boy, it feels like we're in this replay of March and April of 2008, prior to the fall crash, if you will, where the financial crisis really gathered momentum. And to me, these charts that he shows, we'll just put up the image of a freeze frame of Chris's imagery here, really powerful, because you would expect there to be a dollar rally. You would expect there to ultimately be a further washout in the equities markets. They've shown themselves to be top-heavy, overbought. There's still a lot of speculation in the markets. People haven't grasped the reality. Just because this tariff agreement with China has been reached does not mean that the stock market is not still overbought. It does not mean that we don't need a washout. It doesn't mean that there's not still some pain to come. But the way that he overlays these images are really, to me, it's a very powerful testament to his skills, but also what we are sensing just post Bear Stearns in March of 2008.
Yeah, because our argument that price is something that we like to talk about because it gets people's attention short term. But I feel like one of the things, Tori, you and I have always tried to do is encourage people to look at things through fundamental concepts. The idea that you have a major market like gold, big money has been buying gold. Here over at one of our own weekly articles that we put out, Morgan Lewis writes Hard Asset Insights. Here in last week's piece, he's discussing the relationship between the increased gold buying by global central banks over the last 10 years and the price of gold. In fact, it's kind of fascinating that it's not been the investor, but it's been the nations that have been causing this push up in the price of gold. And Vermeulen, over at Technical Traders, argues that as well. Like you just mentioned, we're looking at a gold market right now that is not the 2009, 2010 reaction to the stock market crash.
That's right.
Because the thing that causes people to react hasn't happened yet. And I think the retail or individual investor, whatever you want to call us, the little guy, not JP Morgan buying up 100-ounce gold bars to back ETFs, not Goldman Sachs, not the Bank of China, not the US, for Pete's sake, buying gold for the first time in who knows how many decades. But the individual investors like you and me getting into the precious metals markets, our involvement is almost always dictated by an emotional reaction to something. In 2008, as Vermeulen points out, it was a stock market crash. Money goes first into cash because that's the first fire sell everything. And then it starts looking for alternatives to better protect itself. And that's when you see the real move in gold. There are still phenomenal opportunities in the precious metals markets in the types of products that the US government doesn't care about. 100-ounce gold bars, probably not what I'm interested in buying, but there are deals in the metals markets right now in certain types of products that when the retail investor gets involved, those things dry up pretty quickly.
Yeah, even gold American Eagles, the standard go-to here domestically, hardly a price difference between that and a Canadian maple leaf or a gold bar. So that's not normal. There is an emotional reaction going on with the gold price right now. It's just coming from the central bank sector. With the amount of debt that the U.S. has pumped into the system, they have to respond. And this has been going on since 2008. So talk about overlaying some charts. There's a beautiful overlay here. As Morgan points out, central bank gold buying versus the gold price chart.
Oh, yeah.
And of course they're going to do that. U.S. policymakers dramatically accelerating our own dire fiscal deterioration is going to cause these other countries to respond because it weaponizes the dollar. We've had currency wars. Even the response with Russia really kind of opened Pandora's box. And these countries want alternatives to the U.S. dollar, something that can't be weaponized. And Trump has again telegraphed a clear intention to weaken the U.S. dollar. So, not surprisingly, the global central bank gold buying has accelerated these record levels. And this pullback is beautiful. But I'll tell you what, I don't expect there to be major pullbacks. We're not going all the way down past the 618, in my opinion, because the central banks, again, continue to put a floor every time we've seen a correction in the last 5 years. China leading the charge in that regard. So concrete evidence there of what's really driving it, because you're right, it's not the retail investor, it's not the Western investor, it's not the coin buyer, it's not me and you with IRAs, it is central banks, and we'll see if that continues.
And for those wondering, when Tori mentioned the 618 right there, he's talking about this final market push dating back to the beginning of 2025 when we really broke out following the little break we got in November post-election. But that's gold just at 3,000. While it feels like a relatively deep decline, we're still talking about gold after a correction up $1,000 in slightly over a year.
Right.
Maybe a year and a half by the time we get down there. And you know what's crazy, Tori, is with these inflationary concerns, as we're starting to get a little traction economically, and our White House continues to dance through the victories, if we see a return to lower interest rates and increased inflation, there's a concern that people have right now that Dave McAlvany, Kevin Ork on the commentary have been talking about here, the concept of dollar and gold recycling. And just the sheer volume of currency that's out there internationally that, if threatened, may move deeper into gold. The IMF has already shown us that we're looking at some of the highest gold holdings as a percentage by global central banks, up over 20% now. Hasn't been this high since the mid-1990s. And JP Morgan just had an article come out saying that if half of 1% of the 26, 27 trillion US dollars in assets held outside of the US by foreign investors, if 0.5% of that went into something like physical metals, you're looking at gold well over $6,000 an ounce just
doubling
from that.
in the price just from that. Yeah, that's unbelievable. And I think that you will see a continuation in that regard of the gold to silver ratio staying high. Remember, gold is acting like the money metal that it is. Silver is far more of a commodity. And Hedgeye, the risk management firm, and their analysts have a risk range where they're saying, look, this is the range we expect gold to trade in the short term. That range right now is 3,201 to the downside, 3,431 to the upside. That's a wide range, $230. But we've broken through that downside, but they remain bullish. So in a bull market, you take these opportunities to add to your ounces. The problem that we're facing is that the gold to silver ratio is so high. We're still 98-1 today. So with all of this volatility, gold has dropped proportionally a little bit more than silver has. Silver is still up more than 12% in 2025. So still doing very well, but about half as well as gold. But we'll take it. But that ratio being so wide, even though we're in a bull market in gold and silver is doing well, it's hard not to position on the silver side.
From a chart perspective, silver's been hard stuck in this range for a long time, and I think that's perfectly fine. Just because gold has done extremely well doesn't mean silver hasn't also done well enough. Look at it this way. If JP Morgan is right, and let's say silver does terribly compared to gold, it stays at like 100-1 price ratio, with gold being 100 times the price of silver, that's still silver at $60 an ounce. And it hasn't even made its move yet. So my argument about silver has always been silver is the poor man's gold, and silver is the thing that we turn to when gold reaches a price that's just unobtainable from most people that want it. I don't know what that price is, but the higher gold gets, the higher silver will end up getting, because things always revert back to their means. And the mean on silver is a heck of a lot higher compared to gold than where it's at now. 100-1. Gold to silver, that's not sustainable, and it ain't going to last here forever. So yeah, silver will play catch up eventually. The trick is just not caring when it happens.
Well, and remember, even with gold's retracement here to just under 3,200, by buying silver today and capitalizing on a ratio trade in the future, it's like buying gold at 2,600. So if we do see in that intermediate term chart where we really do have a significant pullback to sub 3,000, and we start getting closer maybe even to the 200-day moving average, that's where you're going to get it anyway if you buy silver today. Let
Sure.
that ratio correct, and you can guarantee yourself that you're buying gold at $2,600 an ounce by buying silver today. And that's why I'm saying that's the hard thing, because this is a monetary environment. This is a gold as money type of dynamic that we're witnessing, and that's what central banks focus on. Their job is currency. Gold is a currency. Silver is technically a hybrid, but really it's not a currency. And so that to me is what drives it. Now, as we look at some of the underlying fundamentals, it's driven gold. One has been market uncertainty, driven by the tariffs. Well, now we have a pause. So Trump has given us a 90-day halt on some sectors for those tariffs in regards
Coming
to
out of China.
negotiations with just China.
Which was the big one.
It was the big one.
That's what the whole tariff thing has been centered about anyway. So this is the big one and the target that this was all predicated on.
Well, it's $500 billion a year in deficit. It is the big one. And there are a bunch of smaller ones, but significant. And it had a dramatic effect on the Chinese economy. Yes, it was having an effect on ours. It was having an effect on the stock markets, which really aren't an indication of economic health, but they are an indication of market sentiment or investor sentiment, if you will. And the bond market gets twitchy, which nobody wants. Bonds really set the interest rate. So nobody wants there to be a bond market collapse or a loss of confidence in certainly foreign held government debt for the U.S. But all that being said, you should expect gold to come down on a little bit of an easing of the tension and a little bit of clarity on this topic of uncertainty with the tariffs. But it's more than that. Everybody has been doomsaying that the sky is falling, but Trumpageddon has not happened yet. In fact, the CPI has actually come in better and lower than expected, which you should also expect gold to pull back on.
It's a couple pieces of potentially positive news. The end goal would be nobody has any tariffs on anybody. It's just somebody had to be willing to bring the other gun to the gunfight, which Trump was willing to do with the tariff discussion. So the fact that we're getting these sit downs, I think, is a positive step in the right direction. His recent hour-long sit-down conversation regarding the American pharmaceutical industry has me wondering what Bernie Sanders has to say about him now.
There's another front of this war.
Yeah, there's another fist fight on this war, is just the rampant price gouging of the American public on various things led out by a very complicated insurance industry in our U.S.
You got to remember that he likes to fire cannon shots across the bow.
Sure.
No harm, just a strong message. And I think that's what we've seen, especially this week. And to me, it has been effective on the tariff front, but also on the geopolitical front. We've got Russia and Ukraine agreeably settling down a little bit here. You've got Iran, who's had a shot across the bow. You've got the Houthis in Yemen that have received their warning shot and have tried to mellow things out a little bit. You've got this big Saudi Arabian deal that he has come to terms with, the defense spending, one that's income for the U.S. and economically stimulating, but it's from a regional standpoint, it just puts our boots more firmly on the ground there.
It's huge.
And that's a good thing, yes. I mean, so geopolitically, and even Syria, you're looking at him working with Erdogan. To me, nobody's talking much about India and Pakistan. We do a lot of trade with them. I'm not too worried about that. This is like a Hamas and Israel repeat cycle that hopefully doesn't blow up into much more. But he's saying things like with the drug companies. He said, if necessary, we'll investigate the drug companies. Well, that's going to cause uncertainty in that market, but it'll scare them straight too. He's trying to get prices under control. So it's listen to what he says and then watch what he does and what is a real threat versus just kind of a red herring. And he's the master of red herrings, in my opinion. But some of this is absolutely real. There are some non-negotiables that we're witnessing, and it will affect the gold price with every success. If you have fear settle, if you have geopolitical tensions reduced, if you have economic numbers like the CPI and the good news on the U.S. budget surplus rising to $258 billion in April. I mean, even the labor market, the Labor Department admitted that hundreds of thousands of Biden jobs were fake. So we're getting some real numbers coming through, some transparency, and the fact that China ignored U.S. trade policy because they considered Biden to be weak, that's actually a positive. It means that they're taking Trump seriously. So all of these can have short-term beneficial effect and a lowering of the gold price. But ultimately, it's this big, beautiful bill that's escalating in Congress. Yes, they're trying to tighten their belt, but Miles, it's just going to increase the debt. It's going to increase the debt ceiling by $4 trillion. We're already looking at $38 trillion, soon to be 40 by this time next year. How do we rein that in? No matter how tight you get that belt, it still seems as if the outflow is greater.
Tori, I think that's the question, because there's short-term pros and cons, and there's some long-term pros and cons, and sometimes you can't redirect a ship with just a paddle. So we'll have to see if some of these recent actions can help stave off some of the potential concerns that we've been building for the last 2 decades. So I think that's going to do it this week for Golden Rule Radio. Please swing by our website if you'd like some more information. You can find us at McAlvany.com. We're also on Twitter at ICA Gold and Facebook at McAlvany Financial. If you'd like to discuss your personal portfolio with one of the advisors here at McAlvany Precious Metals, you call 1-800-525-9556.